This is a member video. Our special report, part 2, this was originally posted for our members back on January 16th, where we looked at the major markets. We held this for our members for this period of time as their exclusive, and now we are bringing it out into social media to share. Many of you have seen part 1, and if not, you might want to go back and watch part 1 on that analysis. This is just very important analysis to these major markets, and you will see that much of what we said is actually coming to fruition already, and I think you will find this valuable. If not for the projections and the markets and the analysis, but for the lessons that you get in how we do approach our analysis in the markets, and I think you will enjoy this special report, part 2, big picture, major markets for 2023. This is a special report, part 2, big picture, major markets for 2023. Just real quickly, you want to go over the legal. All the information at AskSlim.com is for entertainment and educational purposes only, as not to be construed as investment or trading advice. The sole purpose of this website, any oral or written presentation made in any way referring to or relating to this website, is to provide information which could be possibly used by a person or entity in discussions with their investment advisors and or investment decision makers. Does not function as a substitute for the advice of an investment advisor. Consult your own financial professionals and your own trading plan before making any trading decisions. Okay, part 2. Actually, this is the first time I've ever done a part 2, and it was a couple years ago that I said that really I'm winding down and I don't want to be doing the long year-end reports anymore. I'm going to really focus on the stock market, except this year it's a little bit different because I decided to make it more extensive because there are important junctures right now in many of the markets. And I said, well, I really want to make sure that I get these charts over to our level 4 members. And I also want to go over these charts because so many of them are very important. And we're going to only look at monthly charts, though I have some information kind of ported over from the intermediate weekly charts also. So I think you're going to find this extremely interesting. We're going to be looking at the Treasury market, currency market, metals, energy, and then I'm going to do an update on the stock indexes, which have had pretty important moves from when I did part 1 on December 30th. So I think you're going to find this extremely valuable. Let's get going. All right, we're going to start out in the Treasury market looking at both the interest rates and at the 10-year notes. I thought this was an important place to start because interest rates have changed a lot in recent weeks. As we saw a high last year of 4.3% in the 10 years, and that fell down to about 3.4%. And that's the market and investors anticipating that the Fed will turn pretty soon because there is a pending recession. The question is the market correct, or is the Treasury market anticipating what really may not happen, and the Fed might actually stay tight for a longer period of time? Let's start out by looking at the 10-year notes, and this will give you a great example of the kind of things we're going to be looking at in these monthly charts. So this is the 10-year, and this is really an extremely interesting chart because it has 3 cycles that you can see on the bottom that are represented by the cycle brackets. Remember, these are only the ideal energies. These are not the real cycles. The real cycles are how they resolve out on the charts. And you can see in here that there is a minor cycle right in here, and there's an intermediate cycle right here. And if you look at the lows where these minor and intermediate nest, you can see right there and right here and right here and right here. They're really very spot on. And the green areas are the areas of the rising phases. And when we saw this bottoming in here, and we saw the reversal scout turning up, and in early January 22 we said all phases are up, and we knew we were going to have a rally in yields or decline in the Treasury futures market. So the note that we have in here is that rising phases are as short as 6 months and as long as 31 months. And the 31-month length is right over here, as you can see in these last couple of years. The other rising phases have been much shorter. Now there's a more dominant cycle, the blue one, as you can see, and what we have here, these vertical lines are the cycle lines that align with where the lows were made in that more dominant cycle. These gray areas are where all three of them were coming down together, and you had this big decline right over here in yields, a big decline right over here in yields, and a big decline right over here in yields. This is a fantastic chart, as the information that you get out of it has been spectacularly right. And now we're in a different condition. And I want to show you where we are right now as I take a little bigger look at this. So the market peaked as far as interest rates go, and in that 31-month October peak. So this was the longest advance that we had seen in all of these decades. And as far as interest rates going up, and we had a very extreme tightening phase by the government after being so loose for so long. In fact, I just want to go back a little bit and show you that what we're looking at here is the TNX, which was a nearly 40-year bear market in yields. And when you look right over here, you can see the breakout of that downward trend that occurred last April. And that really represents the end of the bear market in yields, in our opinion. And when you see this cycle right over here and how little time it has to decline before the next rising phase in yields takes a hold, you realize that the hope for yields going down significantly just doesn't make any sense when you look at that. So we are now seeing yields pull back as they move down to about 3.4%. And what this really represents is I think, a range that we're going to see in here. Now, the intermediate troughs, in other words, off of the weekly chart, are in July of this year and in January of 24. So what we're really looking for is kind of a range-bound action in here with support around 3.4% and resistances up here at 3.77, maybe 3.87 at the highest level. This up over here is around close to 4%, and I have some doubts about it being able to get back up over there. But we really see under this as a range-bound condition. Trough in July, which would mean a peak in July of the futures market, and then a trough over here in January of 24, which may get down to about 3.10% at that point. So that overall looks like a topping in here, but it's important that the momentum conditions change, and we still have positive momentum here in yields, even though we've had this pullback, and we really would need to see that roll over and then set up this move down into the end of next year. But really what this looks like is range-bound action in here, again, between maybe 3.4%, 3.7, or 3.8% over many, many months in here is what that looks like. So that's a look at the yield chart, and we really think it's going to be overall a range-bound situation with the best case for lower yields or the Fed easing and this market reflecting that being out near the beginning of next year. So it makes sense that we will have a range for the next year. Now, remember, if we look at the 10-year futures, which we'll look at now, which is ZN, we will then see what is really the inverse of what we just saw in that market, the yield market. Now, I want you to notice in here, there is an average of 17-month cycles. Remember that cycles are an average lengths, but when you look at how this worked out, remember those areas that are highlighted in those yellow ovals are the periods of risk when the futures generally turn down and yields go up. you can see, how fantastic this is. That big head and shoulders top that formed gave you a measurement down over here, which was easily satisfied. Once it broke down under this level, it was really an important message, and certainly under this cycle low right there, where it gave you this left-hand translation and a bear market warning, which we put there, way back at this time in 2021. So the patterns in here have been great. You can see the cycles in here. This was a short one at 15, but mostly 18, 18, 18, 17, 18, 17, 17 here. And now the Treasury market is rallying in its third month. Now, when you see that, that is, it tells you that the Treasury market rally has some time to go. It's very unlikely that you're going to get a peak in the third month. There was one time you had a peak here in the second month in this left-hand translation, but to see that, you'd need a pretty big decline in here, which doesn't really make sense. What really makes the most sense, and I'll just get a little closer look for you to see in here, is that this counter trend bear market rally, this rising phase, has some time to go. Now remember that when we looked at yields, the yield market said to us that there are two different troughs that we're looking at, and one would be in July, so that means there's probably a peak here in July, and then there's another peak that comes at the beginning of next year, which we have highlighted here. This is December, this is January, so maybe this should be a little further out. Now, getting way up over here is a 2.6% yield approximately, which is in the 120 area. That is very, very unlikely. And as we showed you, it's more likely that yields stop at around 310. So this area right over here at about 116.5, 117, may be the highest that we can see in the 10 years. This really speaks to the range bound situation that we see in yields coming throughout very much the next year. Then you can see this area here where it calls for a big decline in the Treasury futures. That's where the next upward spike comes out into 2024. So again, this points to a range-bound situation in here. It doesn't make any sense that it would break below this lows over here and give you a breakdown with much higher yields. It doesn't make a lot of sense that it would get much above this level at about 116.75. What makes the most sense is that this will be in a range-bound situation. But again, as you look at this really very, very spectacular secular patterns in here, it really projects to this range bound situation, and you can see the value in understanding the monthly patterns. So if you were trading the futures in here, whether it be the 10s, 20s, and the TLTs or the 30s, it really makes sense that you would be looking for opportunities to be either shorting up near this higher levels up over here over 116, or buying somewhere in the intermediate supports that will show up on the weekly chart, because it's just doesn't seem like it's going to make a lot of ground. Now I showed you that the 10-year yields are in a positive momentum condition still. You can see in here that the 10-year futures are still in a negative condition, as you can see right over there. So this at some point in here is likely to flatten out and turn up, but that's going to take some time in here. So we're just going to look at this range and say that's really about the best that we can see. So that's a look at the Treasury markets, Treasury interest rates, and the Treasury futures in the 10-year. And it really looks like, look for that range, and that can give you some good trading opportunities in there. That's it for the Treasury market. This is my look at the dollar, and it's important to look at the euro also because the euro is 57% of the dollar index. And then when you add in the yen, which I'm not going to look at right now, it is then about 70% of the dollar index. So it's important to do the analysis, especially on the euro, when you're looking at the dollar. Let's take a look here at a very fascinating chart as we look at the monthly chart on the dollar index. And you can see going way back here now, about over 20 years, 22 years looking back, the large cyclical harmonics that show up in there that are really very spot on. The yellow ovals, again, are the periods of risk where there are two cycles, the minor and the intermediate nesting, and that's those gray areas right over there. And then you can see where the most dominant cycle nests with them. In this case, there was a large decline in the dollar. In this case, there was only a small decline, but you can see that that actually was making a big right shoulder. Look at this huge inverted head and shoulders that took about 10 years to develop. And then when it broke out right there, it moved up very spectacularly. And you can see where the inverted head and shoulders measurement was. Wow, I mean, that really shows you how it came up and hit the target perfectly. Then it had a double top right over here, and then where all three nested here set up a period where the dollar was likely to go up in a significant way. Now, when we looked at the interest rates, we saw a period where interest rates were likely to go up at a very similar time. And what this shows you is that there's a correlation between the dollar and our interest rates here, that the big rally came when it was more appealing to get a higher interest rate here in the US than it was in Europe or it was in Japan. Japan, which had that very and still has a very rigid yield curve control policy, which they may be changing soon. So the decline that the dollar had from this panic in here and the upside where it got up to over 114 to come down here to close to 102, that was right on time for this intermediate cycle. And you can see that there is a range of time in here. Normally, these ranges of time on a monthly chart is very wide. It's from the ideal to about 3 months on either side. So there's a wide range of where a trough could come when you're looking at a monthly chart. So that's why this is not for short-term trading or not even for intermediate-term trading. You need to really look at the daily and the weekly charts for that purpose. But you can also see that somewhere in here, there is a low due in the dollar and that next rising phase to come. And you can see how we have it projected. Now remember, when we do these projections, they're based on the ideal cycles. And this, in this case, with a decline stopping here at the 50% level, right in the middle here, it's under the assumption it doesn't really get lower, then the advance over here to only the 50% retracement level at 108.20 is pretty conservative. Whereas the pattern, the ideal pattern would suggest that the rally gets all the way back up here to 114. So I have a conservative amount of advance in there. And the reason I have that is because I have really a conservative look at the range of interest rates that the U.S. is going to have. Plus, I believe that the Bank of Japan is going to change their policy significantly. So that would mean that their interest rates would go up and start to catch up with the rest of the world, and that would put some pressure on the dollar index as money would then be flowing more into Japan than it had. So this advance here to 108 is where I think is the worst case for a move upward this year. Now, this also coincides with the period that we think that yields are going to rebound also. So that yields here in the U.S. Coming down to 3.4% is extremely low based on where our Fed funds are, and also the Fed is not going to want the yields that low. So they're likely to do something to push long-term yields up. That's going to bring a bid back into the dollar. And you can see that right in here is a time frame where the dollar should be beginning to go up. So this has a rally up here into towards the middle of the year. And that is based on the Euro US dollar intermediate cycle. And there's a trough or a low coming in February and in July. So that would mean some kind of a bounce in the US dollar and then a pullback again probably. And then the bigger rally out here into the July timeframe when the euro should be moving down at that point. Then you get into a period here where you get into another period of risk. So this is a time frame where the dollar could do very poorly, but that would be towards the end of 2023 and well into 2024, maybe towards the end of 2024. What that says is that the dollar is projected to drop in a period of risk between Q3 23 and Q3 24. Now, you could say, well, how do you look out that far and say something like that? Well, remember, we're looking at market energetics. In other words, money flows in these rhythms. And you can see that every single time period where there was a nesting between the minor and the intermediate, there was a large decline. You can see every one of those periods in here, and that comes out over here. So the dollar probably is going to be rallying and be okay into mid-year or even a little bit later of this year and getting up at least up to 108 and potentially higher. This level here is 109.70. And then, of course, the high is 114, which I'm not giving it any credit for. So I'd say that the advance in here would get you up to 108 to 109.70. And then after that, that would probably be the best for the rebound in the dollar. And then the period of risk beginning later in the year for the dollar. Now, I want to look at the euro currency, EUR /US dollar, and just get a sense for what the inverse of that looks like. So you get a sense, like we said, looking at the euro US dollar, that it was based on the intermediate patterns, it's likely to have a pullback. So you could see it's come up to resistance right over here and pull back over the next month or so, and then potentially move up again. And where we see the dollar having a hard time towards the end of the year is where a lot of strength potentially comes in the euro right over there. So the correlations, I don't have them lining up perfectly in here, and this period where the dollar is likely to get very weak could keep this euro strong all the way out well into 2024. So right now we look for euro to be pulling back and really to be pretty range bound, and maybe that's the case for the dollar too, where we're going to see the dollar make its way back up to 108 or so, but not really get a whole lot more than that, and maybe the euro move down towards the 103 level and not get a lot lower than that. And again, really looking at pretty much a range here for this next year. But overall, there are, as we have a note right over here, the dollar minor corrective period into Q1 23 is what we were looking for, and you can see that where that decline came, and this this rally here into Q1 23 is where the dollar pulled back the most. So that was there very much in alignment. And then the dollar up into July, so this should probably pull down into mid-year over here. And then the dollar moves down into year end, so this moves up into this year end period right over there. So that's the inverse correlation. And if you're, want to trade these currency pairs, then this gives you an idea for that. There's likely to be some pretty good fluctuation in there with the dollar up into July, and then this moving down into July is what we look for. I don't have the really small cycles in here, so please refer to the intermediate weekly charts to see that. Right now, here in January, it looks like the dollar should be bottoming. both on the weekly and the monthly, and the euro should be topping at the same time pretty soon. So that is a look at the dollar and at the euro. I just want to say that right now the Japanese yen is strengthening. Also, the dollar has been weak, but that's probably going to be an opportunity to see the dollar rebound against the yen fairly soon when this bottom comes in for the dollar, due to happen really any time in here. And the greatest chance for that dollar rebound will be a time period where the interest rates in the U.S. start to move back up again, and that could be pretty soon based on what we see. So that's a look at dollar and euro. Now we're going to look at the metals. Begin your journey of learning one of the best ways to understand and analyze the markets. Go to the slim.com website and go to membership options right over here. And you can see when you click on that, it's going to take you right to the membership options. And what I suggest is for people that are brand new that you subscribe to our 3 months for $45 of our level 1, that's our deal membership, and you will begin that process of learning for really what is a very inexpensive price to be getting daily information from us here. Also, I want to encourage you to go to our workshops tab, and you can see the cycle analysis workshop, and you can learn so much about this style of analysis and have the opportunity to invest in a absolutely fantastic pre-recorded workshop. As you can see, I'm scrolling down and there's a video right there for free. You can learn a lot about this style of analysis, and if you scroll further, you can see what's in each module as you will be learning the process of cycle analysis and have a way to understand markets far different than you ever did. As a matter of fact, once you learn this, you can never go back. This is our cycle analysis workshop, and I think that will help you learn a lot about the style that we look at here at AskSlim.com. We'll look at 4 of them: gold, silver, platinum, and copper. When we looked at the currencies, which are important to the analysis of the metals, we saw that it was likely that the dollar was going to be bottoming soon. And that would normally be a time where there's a risk of some pullback in the metals. And based on what I'm going to show you now, I think you're going to see that pullbacks in metals are likely to set up some pretty good buying opportunities. The dollar is likely to peak sometime around mid-year from its next rebound, and that might take some, after this big move, some pretty good patience for metals investors to wait for a better buying opportunity, because right now these things look quite strong. But then we said the dollar is likely to peak in the 3rd quarter and then move down into late 24. That sets up a whole year-long period where the metals could do spectacularly well and could have historic move during that period. So that's kind of the preface to beginning to show you these charts. This is the gold chart, and once again we're looking at a monthly chart that has pretty fantastic harmonics. When we look at this, you can see there are 3 cycles that we're looking at in here, and again we're going to look at the ideal projections based on what we can extrapolate from the information that we have here. So in this case, the periods of risk are when all 3 cycles are coming down right in here and correcting. And you could see this cycle, the configuration of the cycle was super bullish, because down here where it made its low was around 250, and where this low was made here was around 680. So it was just this spectacularly great configuration. Also, you can see here that the translation, in other words, where did the peak actually come, was way, way, way at the right side here of this whole big dominant cycle. It only left a matter of about 6-7 months for a correction right in here, and that's when you had the correction during that time frame. The same thing that you can see right over here when you got into that 4th minor cycle right there. And then look at this 4th minor cycle right over here. It set up this decline, and we were looking for that, and it just did exactly as we thought, declining into that time frame. Let's look where we are now, and we are at the beginning where all three of these cycles right over here are pushing up. What that means is that this was a period of money flows coming out of the market, where long-term holders were selling, intermediate-term holders were selling, more short-term holders were selling. And you can get into even smaller cycles in here if you look at the weekly chart. And that brought this big sell-off all the way down here from nearly 2,100 all the way down to 1,600. Pretty significant decline. But now, if you look at the previous cycles where all three cycles were moving up in the harmonics, well, right now, where we are right here is equivalent to this. And like I said to you that, based on what I see in the dollar, there could be a time period where the metals markets don't do all that well and don't really take off for a while, maybe towards the end of the year. And that could be like this one over here. It could take a long time before they really explode to the upside again. If I go to the previous beginning of that previous cycle of harmonics, you can see right when I look at this cycle here, that it exploded to the upside right in here and then stalled for several months and made a little triangle for about 5 or 6 months before it took off again. We could get any of those in here because like a dollar rebound is likely to get this to stall. It's getting up to the 61.8% here at 1928. This is 1991 right here. And this might be the area in here where it is not really able to do a lot better based on the dollar getting some kind of a rebound and then pulling back. Now, the buy zones right over here are rising, and those come off of this advance, and if it gets higher, well, these buy zones are going to be higher. And if you get a pullback into them sometime earlier in this year, it's likely going to give you a very good buying opportunity. I really believe that the minimum upside objective for this year is 2,000. Now, if the dollar turns weaker than we believe that it will, and interest rates don't have the rebound up to 3.8%, 3.7, 3.8 that we expect, the metals markets could do better, and it could follow these other cycles up over here to these higher levels and test the high. Right now, we think the highest probability is that it will make it to around 2,000 this year, and really not a lot better, with the highest probability of it doing better probably out here later in the year. So right now it's moving into this period where there would be some resistance and a period where the dollar is likely to rally. And that says to me that somewhere in here it will stall between this 1930 and 2000 area and then begin to get a pullback in here. And if it got down under this 1815, down around 1775, I would really be buying it in that area because I think it's a buy zone and all of these will still be pushing to the upside, and that would be the opportunity. But again, 2000 is a reasonable expectation this year. Based on it only being at 1923, people would say that is way too conservative. Well, that might be the case, and you could test the highs this year. I think that's a lower probability because I think it will have a pullback here once the dollar rebound sets in. And if the Fed gets tough, which I think they're going to get even tougher, then they're going to push interest rates up, and then the metals won't do so well sometime early this year and set up that buying opportunity. So that's a look at the gold market. I think it's an extremely long-term bullish condition with some modest upside still available this year, maybe another $75 to $100, with a possibility of it getting up to 2,100. But then the most likely scenario is that there will be pullbacks and buying opportunities in the gold market. Here's the silver market. Coming up right over here, /SI. And when you look at this, it is, pretty similar, but hasn't been as strong as the gold market overall. And got up to that major 50. You can see the very, very big harmonics in there. In this case, there are 4 cycles that we're looking at because we have the gold cycle mixed in there, that intermediate cycle. And what this is pointing to right now is that this halfway point in this big dominant cycle in the gold cycle, and the quarter point right over here is what set up the big move. This was the pandemic break. This was a false break right over here where things got crazy and oil went to minus $40. Those were all anomalous situations. This all exists within this cycle right over here, and then the pullback in here. This right over here is the 78.6% confluence areas, depending on how you measure the crash low. And it got right down to there and began to move up again. And now you could see all these cycles are moving up right now, and the pattern is pretty much is what we expect in gold. And I think that they're going to track together, where you get a pullback sometime here into the mid-year period, where the dollar probably peaks, does better, rebounds, and then peaks. And then as the dollar turns down again, then a move to the upside. We're projecting that the silver market will make it up to about 2750 this year. That actually percentage gain is bigger than what we see in gold from this point, with the possibility that you could get up to that high near $30. And there is a there is a fib target up there that is way up here for the monthly target zone, which is up about 30.50, which would be a possibility this year if the dollar performed worse than we thought that it will, and that is, of course, a possibility. So again, extremely bullish long-term case that we have in here. Cyclical patterns, very pretty when we see it. And again, we are in an area right over here where the gold cycles are moving up, the silver cycles are moving up, and this getting down to the 78.6% here warns us that the probability of getting back up to the 78.6% here at 2750 is pretty low. It could happen. I'd rate that at 30%. We're getting up more to the 2550 or a little higher is the best percentage there in the silver market. Beautiful harmonics in there. And again, looking at these ideal projections right in here based on what we see in the cycles and extrapolating out the support resistance levels and of course momentum conditions. So when you look here where the momentum condition turned up, and if I don't mention the momentum condition on some of these charts, you can just be peeking at what the reversal scout is telling you, and the conditions in here quite positive overall. Pullbacks will be buying opportunities. That is a very high probability. Platinum, which is giving short-term some signals that it's running into a peaking area right now, is very similar also to we see in here. I have the silver cycle overlaid, so you can see that platinum actually has a longer cyclical pattern in there. And this low right over here came pretty late, as you can see, where the ideal bottom is here, but the actual bottom came about 4 months later, and then began to move up. So it got in line with gold and silver, and is really in a pattern that is a little bit different than them, but still rising in this period. Momentum up, resistance here around 1130. And then resistance about 1223. Platinum was stronger than silver. Did not get down to that 78.6%. That would have been way down over here. And therefore, the probability of getting up here to 1225 or even testing the high at 1343 is better than we see in the silver market. So this is a pattern that is suggestive, again, that if these other metals pull back as we expect into the mid-year period, then that would be a buying opportunity, and then very likely to get a roaring market that could get you from well under 1,000 in a pullback up here to levels of 12 and a quarter up to about 1345 up there at that last intermediate peak. That's it for the platinum market, and you can see it's pretty much in line with what we're looking at. Now, copper, for those of you that follow copper on an intermediate or short-term basis, we said that several weeks ago that copper was a rocket ship ready to take off. So we had intermediate cycle troughs due to form right over here, and then the next one comes out in this one came in July of 22, and then the next one came in January of 23. which was basically right over here. So once those bottoms were formed, it really did take off, and you could see momentum ticking up here. This got support and fell down right to the 61.8%. Based on everything that we see, it should be heading up here to the 462 area and potentially up to the 503 area, with the upside fib extensions up at 505. I'm sorry, 555, and then the top of that up at 621. These are all possibilities. The higher you go, the lower the possibility. And I think the probabilities of getting up to 463 or getting up to 503 are pretty high. I would expect that 463 is a very high probability, and that pullbacks, which are likely to come and likely to come in the into this mid-year period with the other metals, are likely to be a very strong buying opportunity. You can see the harmonics in here. They are not as perfect as we see in some of the other cycles. There's been a lot of shifting in there, so I don't have quite as high of confidence as I do in some of the other metals. But with this low right over here coming, or this low here coming very much on time, this one on time right over here, this on time here, basically over since 2016, these have been pretty close. Even this one wasn't far back off. So this goes back to 2012, and it was off over here in 2009. So looking back to 2012, which is 10 years, these have been pretty consistent, and I have a good confidence that we're going to see testing for these periods up here, these levels up here, 463, 503. In the copper market. So that's a look at metals, and I think the sum of the evidence and the synchronicity that we see in these metals, and when I compare the dollar, all says to me very strong long-term potential for pullbacks sometime into mid-year, and any pullbacks in here being a very high probability of buying opportunities. If there is a surprise amount of weakness in the dollar, that is going to support higher moves and faster moves with greater magnitude in these metals markets. That's this segment of the big picture analysis. Now we'll move on to energy. We're going to look at light crude. We won't look at the products. Light crude is our guide in there, and natural gas. There are a lot of people that follow natural gas, and it has very interesting harmonics when we look at that. We'll start out at /CL, and you can see the vertical cycle lines and how they match up with the ideal cycles in the cycle brackets on the bottom. So the vertical cycle lines are right where the cycle lows were, and you can see how close each of these were to where actually these 17-month average cycles occur. Remember, cycles are measured from trough to trough, and a cycle is a repeating pattern that starts at some point of origination and then ends at a similar length each time, as you can see right in here. Now, there's some interesting things that we look at here, and that is, if you look at this cycle where it jumped all the way up here, then had the break into this late period, or the period of risk as we call it, in the declining phase of the cycle, that equaled this cycle low right over there. Very close, came in about 42.50. The next cycle rallied but failed short of here, and you would expect that when the lows are the same or close over here, or even only down to the 78.6 if that were the case. So when it rallies up there and fails and then turns over, the reversal scout turns down, and then you break down below that low, that's where you got that massive sell-off. And this is the pandemic period right there where it got to minus $40. We would have never, ever, I would have never in my lifetime known that even you could trade negative numbers in commodities. So that was a huge surprise to me, and of course to most other people in the whole world. Now let's just examine these last 3 cycles in here and look at where we are right now. So you can see where the cycle low came right over here. Translation very positive. The cycle configuration super positive. And then the reversal scout, which turned bullish right over here and confirmed the cycle low right there. In this corrective period, did nothing but flatten out and then turned upward again. When you have a super bullish cycle like this was, you know you're going to go to a new high once you resume on the upside, which it easily did. And of course, this was the period in here where Ukraine was invaded by Russia, and the potential for energy shortages, and you had this huge upside move here in light crude, which then came down very quickly. It tested those levels up there again and began to come down, and when the reversal scout turned over, you knew that the peak was in place, and then it would likely decline right through this period over here, plus or minus these months that are in here. Now, I have this marked off. This low right over here was 14 months. So based on what we know about the average cycle rhythms, this seems to be very low for the light crude market to have made a bottom. Now, our analysis in light crude is such that we're looking for it to come down and test these lows around $70 again in the next month or so, and then begin to get into a rising phase. Now, let's just look at the cycle pattern in here. And because this rally failed and got below the 78.6%, it actually got to the major 50. That's off of this low over here. That tells you that the next rally is very unlikely to get up back to these areas over here and likely to fail in the resistance area. So that means that we would look for oil to make a bottom in here. If it hasn't already, it's a low probability that it has made the low, a higher probability that it will come down and test or get below that level in this first quarter here, and then begin to move up. And that resistance level there is around $96, and we would expect that it would be able to get up that high. The whole range over here is $88.70 up to about $104, but $96 is the mid-range there, the 50% level, and that's the area that we would have expect that it would begin to stall and then move down again and go to lower levels out over here. So we'll look for this year to get a rally off of whatever bottom is made in the first quarter, and the peak to be made maybe in the third or fourth quarter of the year, probably getting back up into that mid 90 area in light crude. The next one we're going to look at is natural gas. This is very fascinating when you look at the cyclical harmonics that are in here, looking at three different cycle patterns. And you can see that back 4 cycles ago, there was not perfect alignment because the further you go back, the more chance that it would be slightly off from the present cycle patterns. But you can see the harmonics in there are pretty clear. And in the present cycle, I added in the projections for the very minor cycle. Let's just take a look at these last 2 cycles right in here, so you get the best chance to understand where the market is right now. So you can see the minor quarter cycles and how pretty they are. One here, and then one right over here. The minor half cycle, which is right in here, and then right in here, which then bottoms out over here at the end of this year. And all of them in here nesting right over here that come out to the third to fourth quarter of this year, out into late in 2023. A bottom is due right over here, and we've gotten down to some supports down around that $3.50 area, and then it's likely to get a rally. Now, natural gas is a very volatile product, and it would be hard to believe that a rebound would only get up to the 23% retracement level right there. That would be at about $4.70. It's more likely that it would get up to this level, about $5.75. In this year, and then be subject to this period right over here where all of the energetics are moving down to the downside. This is the period of risk or the liquidation stage, and often containing a capitulation stage as you get down into there. So the blue cycle right over here is in alignment with a dominant weekly pattern that suggests that a dominant cycle trough is December of 23, plus or minus some weeks in there. So that's why we have this projected past the ideal low right over here, because we went to the weekly cycle to get that information. But again, if you look at where we are right now and you look at some of these other cycles in here, you can see that the rising phase of the fourth quarter cycle here was pretty minor, and then it got hit hard right in here. The minor rising phase right in here, pretty minor, and then it got hit over here. That would speak to maybe only getting up here to the 470 level, and then coming down again with a lot of risk out towards the end of the year. Right now, it's in a time frame where it could be bottoming very soon and then getting that upside move. But again, I think the upside move is doomed to failure based on the longer term patterns, and that would then give you a probably a potential for a weak second half of the year in natural gas. So an upside move could be very serious. Remember, 3.5 to 470 or 3.5 to 550 are very big moves and could yield very sizable gains or losses depending on how you're playing it. You can see the momentum condition in here as it turned down right here, and that set up the big decline, telling you there was an outflow of funds there, and that condition is extremely negative right now, as you could see, as it's falling hard. It's going to be hard to turn the momentum to the upside in here, and we might just get something like this where it flattens out and then heads lower again, as happened in that previous cycle in the beginning of 2020. So this is overall a negative picture with the potential for some pretty decent rallies in the middle. So it depends, what your, what style of trader you are. Overall, I would say the opportunity for the next coming months is going to be on the long side. But then the risks are going to come in, and later in the year, the opportunity is going to be on the downside. That's a look at the natural gas market, and we're going to now move into the last segment of the markets that we're going to look at in this video. All right, we're going to look at the stock market. This is an update from part 1 of our big picture analysis year-end show that we did on December 30th of 22. So now here we are about 2 weeks later, and I intentionally wanted to wait a couple of weeks so I could see how some of this sorted out, and then bring an update to the stock market indexes when I did all of the other indexes. A reminder that I'm going to post all of the a chart grid with all of these monthly charts for level 4 members for the Thinkorswim platform. So you'll find that in the normal place that you do get our grids, our chart grids. So you'll be able to refer to that. I'll leave that up for a couple weeks. That is not something we normally supply and would be by special request only for our level 4+ members. So, and it's not something I'm going to keep putting up an update. So for the next couple of weeks, you'll be able to refer to these and work on them to transfer them to your own platforms, whatever that might be. And then I will be pulling them down and not updating again, maybe until I look at a mid-year time period, or if one of our level 4 members makes a special request. I'm going to show you the S&P 500, the NASDAQ, and the Dow. They look all three quite different. Now the Dow is not going to be included on that on the grid that I'll be posting for level 4 members. It just doesn't fit in there, and we normally don't look at it. So if any of our level 4 members want to have that, you can write to me directly, and I will send you that single chart to look at, the monthly Dow Jones Industrials. Let's take a look here as we look at the S&P 500. This is annotated a little differently than the other charts, in that I use stars in there to designate whether it was 1, 2, or 3 cycles. that made those bottoms. And you can see anywhere there were 3 cycles, where you had a steep decline, that is where the liquidation phase is, at the bottom of bear markets. In this case, the 2022 peak in the 2020 peak in the bear market to 2022, 2007 peak in the bear market to 2029, the peak over here in 2015, and the mini bear, which was 16 to 21%, depending on which indexes you looked at. This big break was anomalous. That was the pandemic break. The real low, midpoint low, was right over there. And then this break over here, which we had forecast at the end of 2020, beginning of 2021, and coming down almost exactly to the prices that we were looking for. We thought it could be a 33% bear market. It was past that in the NASDAQ, but only not getting down as far as that 25.6% here in the S&P 500. And you could see it got down to that major 50% fib right there, and where it bounced. So where we are right now is kind of a question mark. When I'll show you the NASDAQ rebound has not been as big, and it looks pretty clear that the next pullback is going to make a lower low. This one is not that certain. Now, what we put up, that the weekly and quarterly cycles, and we put this up last October, suggest a trough in March. And that's how this projects out here to March, or potentially early April, for the low. The upturn in here on the monthly puts that somewhat in question, though what that does say to us is that if you had the break, which we thought originally would get down to 3,200, that's likely not going to happen. And what's more likely going to happen will be a test of that low. When I look at the Dow, this low over here looks like the low in October was the low of the bear market. When I look at the NASDAQ, it looks like it absolutely was not the low of the bear market and will be taken out again. And the S&P 500 looks like it either won't take it out or it will test the low. And we'll be guessing whether or not the bear market ended here, or if it comes down and tested whether it ended there. None of that is going to matter, because we considered that after this bottom is in place, or this bottom is in place, the rest of the year is favorable, and we are anticipating that the market will end up higher for the year, but not a lot, that it would be a modestly advancing year for the year, and that has not changed. So when I look here at the S&P 500, either it was the bottom of the bear market down 25.6%, or sometime in the area of late January, early February, it will turn down again and decline into March to early April, and that would be the low for the year. So either the low for the year is in already, with the bear market being made, and we'll know that by how big of a decline we had here, or the bear market low is yet to be made, and then all of these energies will be taking a hold, pushing on the upside. The Dow clearly looks like that has happened already, as money is moving into the kind of the old moat stocks, and into stocks that are away from the growth that we've seen in the NASDAQ. Those stocks are not in favor, and maybe will not be able to get into favor other than for short periods of time this year. So right now you can see what we're looking for in here, and it's likely to get one more move to the downside. We just don't know how steep it's going to be. And the rest of the year looks favorable to us. So when I look at the S&P 500 on the weekly chart, it is pointing to getting up somewhere around 4,300 or something like that during the year. And that really is going to be my upside target, maybe around 4,300 or a little higher for the S&P 500. That might be lowered depending on the distance that it makes on the downside here, and it might be increased if that is already the low in here, to get up maybe closer to 4,400. But the probability of this new bull market in here making another all-time high this year is very low in our opinion, and much more likely that it will stall well below that level. Now, when I switch over to the NASDAQ, you will see a different picture in here, the same cycle patterns basically that you had seen there in the S&P 500, and the low due right around this area right now, but the amount of the advance is very small and the momentum is still negative in here, which says to us that because we see a downside cyclical pattern setting up for this February-March period, this is likely to go to a lower low. And it'll be clear that the bear market did not end over here, but will have ended somewhere over here with a downside target of somewhere around 10,000 sometime end of March, early April is the way this lines up. To us, this does not look like the low is in place yet, and likely to see that the NASDAQ will lead on the downside. So clear that it's cyclically aligned, that the harmonics are very close in the looking at both the S&P 500 and the NASDAQ, excuse me, but the NASDAQ way underperforming. Now, were this to be the low right over here, then our upside projection for 23 would be a rebound up to somewhere around the 50% retracement level, which would be somewhere around 13,400. There is an alignment with the interest rate patterns also that help us come to that target period on the upside, September to November, as the highs for the year in the indexes. So that projection, 13,400, would only be halfway back from the low, which we're looking for higher level retracement in the S&P 500. A greater percentage of a rebound in the S&P 500. So 13,400 is the upside target in here in the NASDAQ. For the Dow, which we normally don't look at, but I updated the analysis in here, and I have the colored phasing in here so you can see where the positive phases and corrective phases were and how they aligned. Here on the Dow, this looks to me very clearly like the bear market low is in place. And the rally that we expect to come into the third to fourth quarter of the year is very likely to get it up to all-time highs. So the upside targets for the Dow Jones into that period of this of the first leg on the upside in this bull market would be about 38,000 there to 40,700 on the upside. The probabilities of making it to the all-time high, which is up there near 37,000, that's that level right over there, is extremely high. The probabilities of exceeding that is better than 70%. So you can see that, you know, where you want to go to find the stocks that might be the best buys, that may very well be in the Dow. The Dow is in much better shape than we see here in the NASDAQ. As you could see clearly in here, it is not even able to rally and likely to get up only halfway, and to the S&P 500, which I realize I did not put the upside targets in. So why don't we do that right now so that you can see them? This is the peak, this is the trough right over here, and the 50% level. Let's go to the 61.8. That's where we're projecting up to the 4,300 price, and the 50% level right over here, which it's very close to having been made already, is 41.55. So the outside of that would be it getting up into the 78.6%, which would be 45.34. So when I remove that, you can see the upside in there, and I think that the most reasonable target would be right over there around the $4,300 level, which is the 61.8% retracement of this entire downside move. And those numbers will go down if we end up taking out this low, because they will be declining with the indexes. Overall, the sum of the evidence for the indexes is that the bear market either has ended, as the Dow shows, and the new bull market has started, or bullish phase, and the rest of the indexes are soon to follow if they haven't made their lows already. The probability of the NASDAQ having made its low already is small. The probability of the S&P 500 having made its low already is probably 50-50, with a pretty good chance that it's going to test the October lows. And after that, we're likely to see a bullish market and rising market, and overall probably small gains for the year in 2023 for the indexes. That is going to wrap up this entire video where I have reviewed all of these key major markets. Love to hear your commentary on this and what I provided, what the strengths were, what you learned, how I could improve how I could have improved this video as I look at these things one market at a time. This is probably the only time you will see me do this two-part video where I look so extensively at the markets. And as I said early on, I did this because there were so many things that I thought were very important to look at here at the beginning of 2023. That's it. I want you to be really careful. It's so crazy out there, and I'm always wishing you great trading.
Well, I'm going to sit and I'm gonna do a steady show.